Good afternoon. This is Phil Perlman with Yahoo Finance. I'm here at the MTA Symposium 2014, New York City, with Charlie Bilello, Pension Partners Director of Research. Charlie, how are you?
Good, Phil.
Good. Great to have you here.
Yeah, great to be here.
Utilities. Let's. What's going on there? What do you?
Sure.
You guys just put out a paper, research.
Yeah, we were honored. The MTA awarded us the Dow Award for a paper my colleague and I wrote on the utility sector.
Fantastic, and congratulations.
Thank you. Appreciate it. Yeah. So. It's known as the most boring sector. It's the least covered sector on the street, as you know. No one talks about utilities, right? But interesting thing is that when utilities move, it tends to mean something for the market.
Right.
That's where
it's more defensive.
More defensive, correct. So when utilities are outperforming the market on a rolling 4-week basis, it tends to precede higher volatility for the market, more corrections. When utilities are underperforming on a rolling 4-week basis, the market tends to do better. And we showed that since 1926. If you would have used that strategy we outlined in the paper, you would have outperformed by roughly 4% a year over a buy and hold strategy. So it's very interesting. I encourage everyone to read it if they haven't read it.
So you're not, and what's the title of the paper?
It's called An Intermarket Approach to Beta Rotation. So the idea is you're using that intermarket relationship between the utilities and the market to time your beta to the market. When do you want beta? When do you want higher risk? You want it when utilities are underperforming, right? When do you want lower beta? You want it when utilities are outperforming, because that means there's a higher risk of correction for the markets.
So this isn't about getting long utilities, getting paid dividends or whatever. This is about the behavior of utilities.
Correct.
And how that influences your defensiveness or posture in the market.
Correct. Yeah. An interesting thing on the dividend component, it actually is an important component, because you're in roughly 50% of the time in the strategy outlined, you are in the utility sector. And you're benefiting from that compounding of higher dividends for the sector. So you get the benefit of both. You're in the market when the market is running and where dividends don't matter as much. But when dividends matter more in a more defensive environment, you're getting the benefit of compound.
So you're using utilities as a timing mechanism,
right,
and as a proxy for being invested defensively.
Correct.
Beautiful.
Correct. Yeah.
I love that.
Yeah, it's an interesting concept.
And so let me ask you this last thing about it. We're running out of time.
Sure.
But here's my last question. How do you express this in the market?
Sure. Today, right? So we outlined in the paper, right? We showed an index strategy, how to use it from 1926 on, and say, how does an investor today use it? Well, the two closest ETFs would be the XLU for the utility sector and the VTI for the market.
Okay.
And if you looked at the same type
Which
of ratio,
one is the VTI again?
Is the Vanguard Total Market ETF.
Perfect.
So that's the broad market,
and that's pretty liquid as well.
Both very liquid
XLU's
instruments.
Liquid. Yeah,
absolutely.
Yeah. Okay.
So if you look at the ratio, same strategy that we outlined in the paper from 1926, the ratio of the two, and executed that since the inception of both ETFs.
So it's either just get long one or get long the other.
One or the other in total rotation, and it's a weekly timing model. So every week you have the potential where you could switch or not switch. At the end of the week. So
excellent.
Yeah.
Perlman here at the MTA conference with Charlie Bilello. Adios.